All right, glad to have Mike Moseby here. He's going to share with us about the 2-1 buy down. Take it away, Mike.
Thanks, Luis. Again, I just want to take a second to thank you for allowing me to jump on here. I really appreciate our partnership, and I've seen the closings that you've had. And I attended recently in the last month a lunch that you put on for your previous and current clients. That's something that not a lot of real estate agents are doing. So just the fact to be able to partner with you as a real estate professional here in Southern California, it's a very valued relationship. So I just want to thank you for the chance
Sure,
to
sure,
do
man.
this again with you, man. So
No,
thank you.
no, no,
Thanks for that.
no, no,
Cool.
no
So
worries.
so our last video was the basics of qualifying for a home loan. Now we're going to maybe start a couple of pointers about how to submit a more competitive offer and how does the buyer benefit for some new financing tools to lower their payments, qualify for higher. That's kind of what we're going to touch on today. The particular one we're going to talk about is the seller paid buy down. Whenever I print out any of these sheets at an open house, I get a lot of questions about, oh, I thought it was, something that was only for certain loan programs. That's not the case. FHA and conventional loan programs allow for seller paid buy downs. And just a general definition of what a seller paid buy down is, you have a property that's on the market for 500,000. You put in an offer as a buyer for 500,000. It might be difficult in some markets to ask for a credit on top of that because the seller is expecting to make a certain amount of money. So what the strategy is to offer slightly higher than what the seller wants for the property. If for this $500,000 property, maybe 505, maybe 510. And as long as the appraisal comes in at that higher price, the seller is getting more money than they expected. Now the buyer is at an advantage to ask for that $5,000 to $10,000 credit. Usually that credit is used to pay for escrow fee, title fee, lender fee, but there's something new on the market called a buy down, to buy down the rate. These rates are still higher than they were 2 years ago, higher than they were 3 years ago. A lot of buyers are staying out of the market because the rates are too high. Well, this is an example, and we're going to show a couple examples of how do I get my rate lower. We know that rates are supposed to come down within the next 2, maybe 3 years considerably. So if I'm banking on that as a buyer, how do I just make my rate lower for the first few years? That's what a seller 2-1 or a seller 3-2-1 buy down is. Would any buyers have any questions about that so far, Luis?
Okay, hmm. Buyers typically want, I'm just thinking in my head, they typically would like for the seller to cover some of their closing costs.
Mhm.
They would like that.
Mhm.
And I represent typically mostly sellers, obviously.
Mhm.
And the sellers don't want don't always want to, you know, do that.
Right.
Now some sellers are realistic. And when you look at the actual transactions, and you show them that the listing agent does include what was credited to the buyer in the report. So you could see on certain areas, certain properties, certain time ranges, there's credits to the buyer for closing costs.
Mhm.
But sellers generally don't want to do it. But if it's going to make them more money, if it gets the deal
Right.
done for them, then they're more
Right.
open to it. If the home
Right.
is sitting on the market, the home is sitting on the market for a long time, then the sellers will be open to do that. But
Absolutely.
when the rates went up super a lot real quick, there were some sellers that in that time, because they didn't think they were going to be able to sell the property, that
Right.
credited a lot to the
Right.
buyers for closing costs.
Right. Absolutely. So this is a strategy, and just so I can break down what I said before, what I talk to my buyers, realtors about is if we want a 2-1 buy down, which is the smaller buy down, we'll go into the details of what that is. Let's say it's $12,000 and we have a $500,000 property on the market with in January, there might not be a lot of buyers. Maybe it's on the market for 490 or 495. And we're thinking the winning bid is going to be 500. That's what I asked my buyer's agent. What's the winning bid going to be? You think, what's a strong offer that you think we can get our offer accepted? If it's 500,000, then I say, hey, we could get the 2-1 buy down to get the buyer a substantially lower rate and the seller credit us 12,000. Can we go in at 512 and ask for $12,000 back so the seller gets what they want, $500,000 sales price, and the buyer gets what they want with the $12,000 credit?
I see. So that's the question that you answered. That was the main question. How much does it cost to buy down the rate? And you said at 500,000, about $12,000 to lower the rate. And then how much does that lower the rate?
Absolutely. Great question. We're going to dig into that right now. Can I share my screen at this point?
Isn't it, you should, be able to.
Okay, great. So this is the simple, more effective. Is my Excel spreadsheet showing up at this point?
No.
Okay.
You click share screen, then
apologies. Okay, now we have the less expensive 2-1 buy down. What 2-1 means, basically, if today you're doing a conventional loan and the loan agent tells you you have a 7.125 interest rate, 7.125. Maybe your credit's not that good. Maybe the down payment is only 5% down. Usually rates are about 6.5 to 6.8, but let's just say your interest rate today is 7.125. We're going to have the seller give you enough money so that in the first year of your loan, your payment is only calculated off of a 5.125 rate for the entire first year. And the second year, it's calculated off of a 6.125 rate. Now, after the third year moving forward, if you don't refinance, you get back to that 7.125 rate until you refinance. So basically, 2-1 means you get 2% lower the first year on your interest rate and 1% lower on your interest rate the second year. And there's no servicing fee for this option. We just really calculate how much money do you save in the first 2 years by having 1% lower the second year and 2% lower the first year. The total payment on this condominium that we're looking at for this particular transaction, $550,000 condominium with $300 of HOA dues. The normal payment would be $45.47. But your first year, if the seller agrees to this 2-1 buy down, you save a ton of money. Your payment is only $38.72, including the HOA dues, because your interest rate is 2% lower. The second year, you have 1% lower, 6.125. You still save almost $350 on your payment for the entire second year. Now, the third year, it does go up to 7.125, but if you talk to any real estate or financial professionals, we're thinking that rates will go down in the next 2 to 3 years. So you are going to get all of this savings from what your payment is supposed to be, $45.47 at a 7.125 rate. The first year, it's only $38.72. The second year, it's only $42.02. The dollars and cents of that savings over the 2 years is $12,200. That's why we were talking about that $12,000 credit needed from the seller. Now, the seller's not just going to give you $12,000. You do have to up your offer price for the property by about $12,000 at this price range. Now, the next scenario we look at, the 3-2-1, I picked a much higher price range, maybe $1 million property or a $1.1 million property. We'll look at that next. But what questions do you think the buyer might have about this scenario right here, the 2-1 buy down on this $550,000 condo?
So I guess the question is why? Why should I do this rather than just do the traditional mortgage?
Very good. Very good. So the traditional mortgage, there are two options before this 2-1 buy down came from. The first option is just take the 7.125 rate. You don't have any additional closing costs. I'm sorry, your interest rate is too high, but you have over a $4,500 payment. That's option one. Option two was if you did have an additional $10,000 or $12,000, maybe you could pay points. Paying points is a permanent buy down. The $12,000 will maybe get you down to about a 6.5% interest rate. You would save maybe $150 or $200 a month, and you'd pay for it for all 30 years of the loan. And if you refinance in 2 years, you don't get that money back. You just paid
Okay.
that money hoping that you would not refinance soon. You would pay that $12,000 and not really get your money back. The good thing about the 2-1 buy down, and again, there's no servicing fees for this, there's no added fees for this, that $12,000 in this scenario that the seller gives you, what if rates get better in 1 year and you refinance at the end of year 1? Then you get all of the money back that you didn't use the second year. The first year it costs from the 2-1 buy down, it cost $8,000 to get this lower rate and this lower payment. On the second year, it cost about $4,000. If you refinance at the end of the first year, well, what happens to this $4,144? You get that back in the form of a check because the seller gave you this $12,000 credit. You get to use all of it. And if you don't, if magically rates get super lower 12 months from now, you get this second year's worth of repayment back. That's why this is such an attractive thing right now, because people are really thinking that rates are going to get better within the next 2, maybe 3 years. This 2-1 buy down to get a substantially lower payment. I mean, look how much lower that payment is the first year.
Okay.
45,
Okay.
47 down to 38.72.
Okay, here's a me question.
Mhm.
I'm not necessarily a buyer, so I'm not going to care about me. But can you go down?
Sure.
Okay, so at the 38.72 payment, my understanding is you would need to make about $7,700 a month to qualify for that payment, right? Times 2. So the C payment of $4,200, you would need to make about $8,400 to qualify for that payment. The D, you can correct me if I'm wrong, 45.54, you're gonna need to make about 9,100, 9,000 to qualify for that. So if I'm gonna buy this property, does the buyer need to qualify for the B column payment, the C column payment, or the D column payment?
The D column payment.
I see.
The banks always look at worst case scenario. The bank, I would love to qualify you only off of this low payment. But if rates don't get better within the next 12 months, you're in a poor position, because what if you barely make 2 times this amount? Your debt to income ratios are maxed out. What's going to happen in the third year when you have this $4,500 payment? You're going to foreclose on the property because you just can't make the payment. That's not good for the buyer. So the banks always take worst case scenario. So this is column number D that you get qualified off of.
Okay.
You get this great savings the first 2 years, but
That's fine. So they're conservative in terms of the amount of qualification that you have for this.
correct.
And so it sounds, let's just say, too good to be true, a buyer might say. Are there any risks of this?
There really aren't. The one caveat that I've said that's a really important part of the conversation is to ask your buyer's realtor, what do you think the winning bid is going to be? For this particular scenario, the winning bid is going to be, just under, $550,000. It's going to be less, $12,000. So that's why our offer on this property because in this scenario, the buyer's realtor is going to say, for this condo, I think the winning bid is going to be $538,000. I really think it's a strong offer. Maybe it's on the market for 530 or 535. We really think 538 is going to be the winning offer. I, as the lender, will say, okay, great, Mr. or Mrs. Realtor, you think 538 is going to be the winning bid? How about we bid 550? And we ask the seller for a $12,000 credit to get this nice low rate the first year and this nice low rate the second year for the buyer. We ask for this $12,000 credit. So the seller gets what they want. They get $538,000 for the property. We give them $550,000 for the property and ask for this $12,000 credit to buy down temporarily the buyer's rate down to these nice, sweet, low rates. So that's the conversation that needs to happen every time. And I talk to loan officers a lot during the day. They're not having this conversation. So that's a really important question that you just asked. Is it too good to be true? When it is too good to be true, if the property's not worth 550,000, if I ask my buyer's realtor, do you think the comps are going to come in at 550, and they say no, it's only going to come in at 538, well, then the lender can only lend on the lower of the appraised value and the sales price. So you're going to lose that $12,000 credit if you don't ask your realtor, is the value of the property slightly higher from the comps that you're looking at in the area, slightly higher than what we're offering? And usually the appraiser will bring it in, if it's off by just like $2,000 or something, they'll bring it in at the offer price, 550.
Okay, interesting. Now here's a comment that a buyer might make. Can we go down so we can see the payment?
Sure.
So yeah, I'd rather right there. That's fine. So instead of paying I'm not sure if the Zoom will record this, what I'm highlighting, but I don't want to pay the 35 or the $4,500 here. I'll wait till the rates come down.
Yeah.
To
Yeah.
5.25,
Five and a quarter,
when the
yeah.
rates come down, then I'll lock in my low payment of 3,800.
Great question.
That's yeah. I don't want to even worry about this 7%. I know the rates are going to come down, so I'll just wait. They come up, they come down.
Yeah.
So
and I will tell the buyer, you're absolutely right. Rates are going to come down. 100%, they're going to come down within the next 12 to 24 months. So I asked the buyer, this property is on the market or the winning bid for this property is going to be 538. We've already established that. That's why we're asking 550 to get the $12,000 credit. I asked the buyer, okay, today your rate and every other buyer's rate is going to be about 7.125. A year ago, it was at 8.125. So it was maybe smart of you to wait a year. But if rates go down 1% in 2024, down to 6.125, and rates go down another percent, 5.125 at the end of 2025, is that the time that you would like to buy this property that's the winning bid is 538? The buyer would say, yes, I would love to wait for rates to come down to 5.125. I will ask them, what do you think this property will be selling for once, twice, or 3 times, or 4 times as many buyers are on the market? Within the next 2 years, as rates start to come down, more buyers are going to come into the market and bid up these properties. The comps, the properties that are selling around this property are not going to be selling for $538,000. What do you think, Mr. or Mrs. Buyer, this property is going to sell for? It's going to be selling for way over $600,000. That is, just look at the history, the property history of this property. What was this property and ones like it selling for in 2022? What were properties like this selling in 2020? What were properties like this selling in 2018? Every year they've been going up by $75,000 or $100,000. Every year the values have been going up. So when interest rates go down to your sweet little 5.125, what do you think the sales price is going to be? So to save your, and we'll do the math, you're saving, from 45.47 to 38.72, you're saving $600. So times that by 2 years worth, you're saving $16,000 by waiting 2 years for interest rates to go down. But you're losing maybe $100,000 in value because this property is going to be going for well over 600,000 2 years from now. It might be going for 650. So why on earth would you save $16,000 to lose $100,000? That math will never make sense to me.
All right.
I mean, it's kind of funny. It's funny, not funny, kind of.
Well, here's something that someone might say. Well, remember in 2008, 9, everything came down like in half. And so I don't want to, you know, get this rate right here, and then the payment goes up, and then my property value goes down. So, you know, I'll wait till the
Yeah, I
properties
mean,
come down.
Properties are always going to ebb and flow. Something is going to make properties go down. We, as real estate professionals and financial professionals, are not seeing anything on the horizon short term to make property values go down. If anything, like we've discussed on this call, there are a lot of things that are going to make property values go up. The main thing is interest rates. As interest rates go from 7% today to 6% a year from now to 5% 2 years from now, which even Freddie Mac is saying, property values rationally are going to go up. Because I myself, I'm one loan officer. I have 35 buyers waiting for interest rates to go down. I just can't convince them to get on the market, start making offers, start making competitive offers, and buy their homes. And I'm just one loan officer. Multiply that times a few tens of thousands in this country waiting for interest rates to go down. So when interest rates do go down, you're going to have a flood of buyers to increase very naturally. It's a very natural supply and demand, free market capitalism thing to do. It's not doing bad loans, which is what made property values go down previously. We were giving away money for free, and that was not a very good decision. That's what made property values go down. There's nothing on the horizon that short term in the next 2, 3 to 5 years to make property values go down. They're not going to do anything logically but go up.
So what I'm hearing is the rates are projected to go down,
Mhm.
and when the rates come down, you project that the property values are going to go up.
And it's not just me. I mean, if you're a buyer who's on the market, who's been on the market for at least 2 to 3 years, you see what happens when interest rates go down. All of us saw COVID. As a personal aside, as an opinion, it was a brilliant idea to make interest rates low during the worst pandemic we've seen in 100 years, regardless of your politics. That was a great idea to keep interest rates low and to make them even lower so that businesses could borrow money while their businesses were not doing good. People could buy and sell real estate very, very, very easily. Property values went through the roof. And really, rates only went from 4.5 down to 3, 1.5%. That's what the COVID boom of property values happened. What Freddie Mac is telling us is that today's interest rate, 6.5 to 7%, 2 years from now is going to be 5%. So, we just saw it 3 years ago. We just saw this happen. The only thing to make the buyer feel like they do know what they're talking about, because there is some truth in this, at some point in Southern California with these property values, we're going to get to a point that a well-paid married couple can't afford a home. At some point, we're going to get to that point. 65,000 to 68,000 is the median income right now. In some neighborhoods in Southern California, a married couple with the median income and no debt whatsoever can't qualify to buy a house. They need a brother or a grandmother or somebody else on the loan to qualify just to make the mortgage payment. So at some point, homes are going to become unaffordable, and that might stagnate property values, but there's still going to be equity to be made. What needs to happen, another kind of political aside, what needs to happen is salaries need to raise, because inflation, gas, eggs, and houses are much higher than what our current minimum wage and our current median income is. I'm going to just leave it there. And that would help the economy out a lot if these people, doing the work in our country were actually paid what they're worth. But yeah.
Okay. All right. So another comment, not really a question, is, well, I want to see what happens. We're having an election. I want to see, if Trump wins, I think he's going to make the rates go down. Then
Mhm.
that's a common. That's
Sure.
not uncommon to hear that.
I've heard that. Yep.
And
What happened what happened last time Trump made rates go down? What happened to property values? They went through the roof. And for one property, we had 25 buyers putting in offers. So would you rather have a 7% rate with 2 to 3 buyers to compete with? And then if Trump comes in office, then you refinance down to the 5% rate, or maybe lower. I don't know. But then you have the equity, because this $550,000 property is going to be worth $100,000 more. That's money in your bank account. And you can refinance to the lower rate after whoever gets elected. If the current president gets reelected, rates are probably going to stay the same and start to drop slower. I agree with that. If the other candidate, the Republican candidate, gets elected, rates will probably drop, because now we know that the president can raise and lower interest rates off of just their political will. They probably will go down quicker, but that's going to make property values go up, which is very bad for first-time home buyers, very bad for renters, because you don't want to buy an appreciating asset in the future. You want to buy an appreciating asset now so that you gain the equity of that appreciating asset. You don't want to wait for a $500,000 house to be $700,000 2 years from now. Why would you wait to lose $200,000? Because then you won't qualify.
That's definitely something to think about.
Yeah. Do you want me to go through the 3-2-1 buy down? It's really just
Sure,
one
sure,
additional
let's do that.
column. Yeah, it's really just one additional column, and it's a higher price point. This is not really the the first time home buyer traditional, but I did want to kind of look at what a higher price point would be. This is in LA County, this is the most expensive home you can qualify. Go ahead. Thanks, Luis. Now, here we have a client who's looking at the top of their price range for a conventional loan in LA County. In LA County, the maximum loan amount that they'll give you is about 1.12 million. The buyers come in with 20% down, and they want to buy in the price range of 1.4. These higher price ranges allow us to ask for bigger credits, because we can increase our sales price, kind of that conversation I was talking about before. What do you think the winning price will be? We can increase it by 25 or 35 or 50,000 a lot easier at a property that's worth 1.4 million, as opposed to a $550,000 kind of a starter condo. So this is a client that's putting 20% down. As you can see, again, this is a 3-2-1 buy down. This E column right here is what the normal payment would look like for this $1.4 million home that they're putting 20% down. Their loan amount is 1.12. The interest rate's a little more competitive, 6.625, because they're putting 20% down. I think they have a little better credit as well. So their payment should be, including property taxes and homeowners insurance, $8,800 a month. And to your point, they need to make twice that amount to qualify for that, to answer that question. So what the 3-2-1 buy down does, where the par interest rate, today's interest rate is 6.625 for this particular client, it buys down 3% the first year.
Wow.
The first year you get down to 3.625 for the entire first year. The second year, it's 2% lower, 4.625, and 5.625 the third year. It gives you that third year of security of a lower payment and the seller's paying for it. The payment differences are astronomical. You're paying over $2,000 less the first year, from $8,800 down to $6,700. You're paying, $7,400 the second year, $8,100. There's still over $700 savings per month on the third year. And then the fourth year, if you don't refinance, you go back to the $8,800. So the cost for this is quite a bit. It's $50,000. So really, the winning bid on this property, and I told them, when you're looking for properties, the winning bid needs to be about 1.35 or $1,350,000 because we need to incorporate a $50,000 credit from the seller. The seller's losing $50,000 to pay for this buy down. So the winning bid from the seller's perspective needs to be 1,350,000. We bid 1.4 million. The seller gets what they want, and we get our $50,000 credit to pay for these savings.
Wow. So it costs about 3% to get a 3-2-1 buy down. Is that right? 14 times 3 is about 51. It's a 2.8% to buy it down. This.
Yeah, you're
Okay.
taking the cost of the buy down divided
Yeah.
by the purchase price.
Yeah.
Yeah.
2.8%, 2.9.
Yeah, yeah.
Okay.
What it is the dollars and cents every year, the difference between 8,800 and 6,700 for the first year, that
Mhm.
dollars and cents savings is 24,000. The second year, the dollars and cents savings is 16,000. And then the third year, the dollars and cents savings is 8,600. When you add those three numbers together, that's how you come up with the $50,000 total credit that we need. Again, there's no servicing fee, there's no add-on fee, there's no fee to the seller, there's no fee to the buyer. It's just the bank saying, look, we're going to make $8,800 a month one way or another, because the interest rate today is 6.625. Either the buyer pays for it by just straight up paying $8,800 a month, or we'll give the chance for the seller to pay for it. If the seller's okay with giving you $50,000 for the first 3 years, we'll spread it out evenly, and you'll get a 3.625 rate the first year, 4.6 the second year, and 5.6 the third year. If you don't refinance after that, it goes back up to 6.25. So like to your point previously, this is what we qualify you on. You have to make over $16,000 a month, or, $180,000 a year to qualify, not including your car loan debt, all your other debt. But yeah.
Okay. No, sounds like a great opportunity for someone to get a low payment and work in there. Not bad.
Sounds good.
Not bad.
Sounds good.
No, it's good. It's good to have numbers. It's good to have numbers with actual, you hear loan programs, but without the numbers, you don't really know. It's kind of
Yeah.
like a vague concept.
Yeah.
So,
What I try to do for the realtors that I work with is, if I'm not sitting your particular open house, I can make you a spreadsheet for this, because buyers are coming into your open house, whether I'm sitting there or another lender is sitting there or no lender is sitting there. They want to know, "God, interest rates are kind of high. I don't want to buy this house. Oh, here's this little, for a $500,000 condo, here's this little $12,000 credit that can lower your payment by 2% the first year." That's a very great tool for a listing agent to have, for a seller to have, that it works with a lender that can do this 2-1 buy down. Not all lenders can do it. We can do it for FHA or conventional. We have a couple jumbo lenders that do it too. What properties do you have on the market right now? What are you?
well, there's one in Bell. It's coming soon. We're waiting a situation with an occupant that we haven't been able to come onto the market yet with that one.
Mm-hmm.
And then the one in Palmdale, like, it's been on the market a little while, so she already agreed to a seller credit to the buyer to help buy down their rate. So like
Nice.
1.125 is the amount of buy down she's getting.
Got you.
So
Got
that's
you.
what we have right now.
Cool. The property that's in Bell, is that a single family residence?
It's a 3-bedroom, 1 bath, but then it has a garage which is converted very nicely, not yet with full permits.
No.
But as we know, that there's been a number of properties in that neighborhood that even though they don't have the permitted, still buyers are willing to pay about 200 grand more for the extra without permits.
I do want to touch on that really quickly, just to clarify
a minute
for
and a half.
everybody. Yeah, you don't for a lender's perspective, and really for a buyer's perspective as well, because the appraisal is there to protect the buyer. Things don't have to be permitted. They have to be done in a workmanlike manner, and that the comps, the other houses in the area, need to have similar work that's done on them. Maybe it was originally a 2-bedroom, 1 bath, and then they had an addition of an additional bedroom. As long as that's done in a workmanlike manner and the appraiser comes out, they give full value for that addition, as long as the comps in the area give that too. So that shouldn't be a hindrance for that buyer, the fact that it's not permitted. I would say 90% of the additions in Los Angeles that I deal with are not permitted. but they're done in a workmanlike
Even
manner.
the garage, unpermitted, the garage converted into a bedroom and bath and kitchenette.
Absolutely.
Okay.
Absolutely. Yeah. And it helps a lot if that some of the neighboring sales also
All right.
have converted garages.
15 seconds. Any last words, Mike? Last words. Thank you.
No, I appreciate you. I really appreciate your partnership. Reach out if you guys need anything.
Yeah. All right. Talk to you guys soon. Take care.